welcome to the research desk.
Glad to be here. We have a lot of ground to cover today.
We really do. So right now, the market is aggressively rewarding stories of scale, artificial intelligence infrastructure, massive reshoring efforts, and just sheer unadulterated strategic reinvestment.
Right. The bigger the budget, the better, supposedly.
Exactly. The universal assumption governing capital allocation today is that aggressive top-line growth combined with heavy capital spending is the ultimate proof of ambition. It's seen as proof of strategic strength.
Which is a very comfortable narrative for management teams to sell.
Oh, absolutely. When a company announces a multi-billion-dollar capital expenditure program to build data centers or next-generation manufacturing facilities, the market interprets that as a signal of absolute dominance. They see it as the widening of an economic moat.
Right. They see the spending and assume the moat is getting deeper.
Yes, and I'll be honest, I take the bull case here. I look at the history of the most successful public companies, and I see early, heavy growth capital expenditure building these unstoppable future profit pools. I champion the idea that this period of aggressive investment is simply the gestation phase of a multi-decade compounder.
Well, I have to step in right there because that assumption is a trap. It really is.
A trap. That's a strong word.
It is, but aggressive reinvestment is rarely proof of a widening moat. More often than not, it is a distress signal.
Wait, a distress signal? How do you figure?
It's evidence that a business is trapped in capital hunger and industry entropy. They are forced to spend billions simply to stand still. I look at the historical data and I see something entirely different from a widening moat.
See them just burning cash.
I see capital furnaces destroying shareholder value. The market consistently confuses spending with investing. And worse, it confuses the preservation of revenue with the actual creation of value.
Okay, so we are going to stress test that bullish narrative today. We need to examine the anatomy of true multi-decade compounders versus these capital destroyers you're talking about.
Exactly. We have to move past the illusion of the income statement. We need to look at the harsh physics of corporate entropy.
Well, we should start by examining the most powerful evidence for the phenomenon of self-funding growth. We have to look at the delay payoff.
The delayed payoff, right, the classic defense.
It is, because it's a concept that completely confounds traditional financial analysis. And, the ultimate expression of this is the Amazon story from roughly 2010 through 2022.
Oh, of course. The Amazon example. Everyone brings up Amazon.
Because it works. For years, classical value investors just completely dismissed Amazon. Bears looked at the endless spending on fulfillment centers, the logistics networks, the early build-out of AWS.
Right, because near-term free cash flow was just continuously suppressed.
Exactly. For our listeners, free cash flow is simply the cash a company generates from its normal business operations after subtracting the money spent on capital expenditures. Because Amazon was spending billions on warehouses and servers, that free cash flow number was artificially depressed.
They looked terrible on a traditional spreadsheet.
They did. The common critique was that Amazon was a profitless revenue engine, fundamentally incapable of generating surplus cash for owners. The assumption was that the core retail business was simply too capital-intensive to ever produce a durable margin.
But then the narrative flipped.
So what actually happened? Think about this for a second.
I'm listening.
Jeff Bezos was not funding maintenance. He was constructing future profit pools. In 2012, Amazon generated just $676 million of operating income on $61 billion of revenue.
Wow. Wait, $676 million on $61 billion?
Yes. Think about those mechanics. A margin of barely 1%.
That's practically a grocery store margin, or worse.
Exactly. If you were running a traditional screen on financial health, that looks like a profoundly weak business on paper. You have tens of billions of dollars moving through the system and almost nothing dropping to the bottom line.
But the infrastructure was being laid.
Right. By 2022, operating income reached $12.2 billion on $514 billion of revenue. And it had actually eclipsed $46 billion in 2021.
The scale just eventually overpowered the spending.
Yes. The early low cash years were not evidence against compounding. They were the essential investment phase of compounding. Bezos was building a logistical footprint so vast and so deeply integrated into the consumer economy that no competitor could ever afford to replicate it.
I'll grain to the moat there. It's undeniable today.
And this brings us to what I consider the true DNA of a long bull stock. It is the free cash flow inflection point,
Meaning the moment the spending tapers off.
the moment when the installed asset base begins to throw off cash faster than management needs to reinvest it.
You lay the heavy physical infrastructure once, and then the incremental cost of servicing the next million customers drops precipitously.
The machine shifts from consuming capital to violently producing it.
Violently producing it, yes. We see the exact same architecture in Tesla's early gigafactories, right? In the early 2010s, the massive capital commitments to battery and vehicle capacity were heavily criticized by Wall Street.
Oh, the analysts hated the gigafactories. They thought it was a massive cash bonfire in Nevada.
Exactly. Traditional auto analysts looked at the billions being poured into these massive facilities in Nevada and eventually Shanghai, and they just saw a cash bonfire. But that spending was not allocated to preserve existing output.
They were trying to scale.
It was designed to scale production and drive battery costs down the experience curve. The reported cash profile looked dreadful because the infrastructure was built before the earnings arrived.
Buying future operating leverage. Precisely. The economic logic was mathematically sound. The initial spending depresses near-term free cash flow, but it ultimately creates an infrastructure moat that allows revenue to scale significantly faster than the subsequent maintenance burden.
So they build the massive factories up front, so the marginal cost of the 5 millionth car is vastly lower than the 50,000th car.
You hit the nail on the head.
Okay, but let me push back here. You are pointing to Amazon and Tesla, right? Two of the absolute apex predators of the modern market. And you're extrapolating a universal rule from them.
I think it's a structural rule, not just an exception.
The problem with that framework is the inherent classification risk. You are taking management entirely at their word.
How so?
Management teams always label heavy spending as, quote, growth capital expenditure. If you read a corporate proxy or listen to an earnings call, every single dollar spent is described as a strategic investment in the future.
Well, sure, they have to sell the vision.
Right, but they tell the market they are building the next AWS or the next gigafactory. But a ledger category is not an economic fact. Just because a CEO categorizes a billion-dollar factory upgrade as a strategic growth initiative does not mean it actually results in a widening moat.
Sometimes an upgrade is just an upgrade.
Or worse, it just means the old factory became obsolete. They are running in place. We need a much more rigorous analytical lens here to separate the true compounders from the capital destroyers.
Okay, what kind of lens are you proposing?
I look at this through the metaphor of corporate thermodynamics.
Thermodynamics. Okay, I'm intrigued. Go on.
A company is an entity constantly fighting entropy. In physics, entropy is the natural tendency of systems to move toward disorder and decay.
Things falling apart.
Exactly. In business, entropy is the natural tendency of your margins to compress, your assets to degrade, and your competitors to steal your market share.
So every business is fighting a constant battle against decay.
Yes, but the battlefields are different. Some businesses live in low entropy environments, and others live in high-entropy environments.
Give me an example of a low-entropy environment.
Think about enterprise software or digital payments. The installed asset base decays very slowly. Innovation and maintenance are delivered through code, engineering talent, and product updates.
Right, you aren't replacing rusted machinery.
Exactly. You write a piece of software once, and you can distribute it 1 billion times with virtually no physical wear and tear. That is low entropy.
And high entropy would be what? Manufacturing?
High entropy businesses are heavy industry, resource extraction, physical manufacturing. The physical assets are constantly degrading.
Depletion, rusts, frictions.
All of it. Physical wear and tear and geopolitical supply chain shifts force constant reinvestment just to preserve your current competitive position. The universe is actively trying to tear your business down.
So the baseline cost of survival is just massively higher.
Exactly.
To see this clearly, look at the collision between Microsoft and General Electric over the decade from 2010 to 2020.
That's an interesting pairing. Two giants, totally different models.
Right. Over that exact period, Microsoft and GE had remarkably similar capital expenditure to revenue ratios. Microsoft averaged 4.5% and GE averaged 5.8%.
Wait, really? Microsoft and GE were spending roughly the same percentage of revenue on capital expenditures?
Yes. If you just ran a raw quantitative screen, you might look at those numbers and conclude they had similar capital intensity. They were both reinvesting roughly 5% of their top line back into the business.
But the outcomes were entirely different.
Completely different. And the divergence in how they fought entropy explains everything. Microsoft spent 13.5% on research and development. GE spent only 4.2%.
So Microsoft was investing in intellectual property, not physical property?
Yes. During that decade, Microsoft expanded its operating margins from 33% to 44%. They were preserving code, securing the cloud, and scaling digital architecture.
And what happened to GE's margins?
GE's margins compressed from 15% down to 4%.
Wow. From 15 down to 4. That is brutal.
Because GE was resisting physics. Turbines wear down. Jet engines require massive, incredibly expensive maintenance cycles. Supply chains for rare earth metals snarl and break.
The physical world is just relentlessly expensive.
It is. Heavy assets demand massive continuous upkeep simply to function safely. GE was spending billions just to keep the lights on and the engines turning, while Microsoft was spending billions to lock the entire corporate world into their software ecosystem.
Okay, I see your point. The nature of the spending matters just as much as the amount.
This dynamic creates what I call the capital treadmill, which we can understand through an ecology analogy.
An ecology analogy? You're bringing in physics and biology today.
I find it helps clarify things. Maintenance capital expenditure is the baseline metabolism of an ecosystem. Think about an animal that has to consume 10,000 calories a day just to keep its heart beating.
That is a very demanding metabolism.
It's a brutal baseline. Some companies never actually expand the carrying capacity. They never grow the total amount of profit they can generate. They simply pay a recurring survival tax.
A survival tax. So they are spending just to stay alive, not to grow.
Exactly. And the purest example of this structural entropy is the United States shale oil industry over the last decade.
Oh, the shale boom. I mean, on the surface, that looked like an incredible growth story.
Right? The headline production growth looked absolutely spectacular. Wall Street celebrated the sheer volume of oil coming out of the Permian Basin.
The U.S. essentially became energy independent because of it.
It did, but you have to look at the geology, the physical reality of shale. When you hydraulically fracture a shale well, you get a massive initial burst of oil. But then, the geological pressure drops exponentially.
The depletion curves are steep.
Incredibly steep. If capital spending stops in the shale industry, well production falls 50% in just 18 months.
Wait, hold on. Half of the production disappears in a year and a half if they stop drilling?
Yes, that is a devastating baseline metabolism. It means a massive share of what the industry labeled growth Capex was actually maintenance disguised as growth.
They had to drill new wells just to replace the dying ones?
Continuously. They constantly deployed fleets of rigs and pumped millions of gallons of water and sand, just to offset the rapid depletion of the old wells.
So what was the financial result of all that activity?
The result of that treadmill? The industry burned more than $300 billion in cumulative negative free cash flow over a decade.
$300 billion. That's just staggering wealth destruction.
It was the illusion of compounding built entirely on a foundation of capital destruction. They were running a marathon at full speed just to stay on the exact same inch of ground.
Okay, I understand the gravity of the shale example. But I think you are framing the capital treadmill as a universal negative.
Because it usually is.
Usually, maybe. But you describe it as a survival tax that inherently destroys value. I would argue there are distinct periods where massive capital deployment in physical infrastructure is not merely maintenance.
What else could it be if it's not expanding the profit pool?
Nor is it a futile attempt to outrun depletion. It is adaptive reinvestment for survival and future resilience under extreme geopolitical duress.
Adaptive reinvestment?
Yes. Sometimes the rules of the game change overnight, and capital intensity is your only shield. Consider the 2022 European energy shock following the invasion of Ukraine.
Well, that was an unprecedented macro event.
Exactly. For decades, the European industrial model relied on cheap, steady piped gas from Russia. Suddenly, that pipeline was shut off. The baseline metabolism of the entire continent was threatened.
They had to replace the energy source immediately.
We saw European energy companies and governments pour billions of dollars into liquefied natural gas import capacity, right? And new maritime gas infrastructure, almost overnight.
They built those floating storage and regasification units incredibly fast.
At a speed that shocked the world. Now, under your strict thermodynamics lens, one might classify that massive spending as a desperate attempt to maintain the existing energy grid.
Well, technically, it was. It didn't increase Europe's energy output.
You might call it a high-entropy survival tax, because it did not technically grow the total amount of energy consumed. It just replaced what was lost. But that ledger classification completely misses the economic reality.
How so? The core business of Europe didn't grow, it just survived?
Because that capital was deployed to structurally reposition the entire continent's energy architecture. It was adaptive capacity being built in real time.
Okay, I see where you're going.
Replacing highly vulnerable, single point of failure pipelines with diversified, resilient maritime LNG infrastructure preserves current output, yes, but it also transforms the future strategic flexibility of the business.
It changed the risk profile.
Exactly. You cannot naively dismiss that spending as a treadmill. Sometimes heavy capital intensity is the only mechanism available to alter the fundamental rules of the industry you operate in.
Fair point.
Without that rapid, massive deployment of capital, the European industrial base would have collapsed entirely. The spending was defensive, but it fundamentally rebuilt the moat on safer ground.
Okay, I'll concede the European energy pivot. But that was a state-backed necessity driven by a literal war.
It was an extreme example, I admit.
In the broader corporate landscape, aggressive reinvestment is frequently a mask for a deteriorating core business. Your defense assumes that heavy capital deployment inherently leads to a stronger structural position.
If deployed correctly, yes.
But this ignores how heavily reinvesting companies can hide their underlying decay through financing structures and accounting mirages. This brings up a concept I call regime dependence.
Regime dependence? Like a macroeconomic regime?
Exactly. A business can look exactly like a compounding machine simply because it exists within an accommodating macroeconomic or regulatory regime. The moment the regime changes, the entire illusion shatters.
Do you have a specific example in mind?
The collapse of Evergrande is the perfect warning here.
Spectacular implosion.
It was. For years, Evergrande looked like an unstoppable engine of scale and growth in the Chinese real estate market. They had massive land banks, spectacular top-line revenue growth, and an ever-expanding footprint of residential towers.
They were just building cities out of thin air.
They were deploying capital aggressively, buying up land and launching new projects at a staggering pace. The market read that capital deployment as a sign of dominant market presence.
They looked like the Amazon of real estate, using immense scale to box out competitors.
That's exactly how they were perceived. But the entire operating model was highly regime-dependent. You have to look at the actual mechanics of how they funded that growth.
It was heavily reliant on debt, right?
Yes, but specifically, they relied on the pre-sale model. Home buyers pay for apartments before they are even built, and they relied entirely on China's property credit machine, tolerating immense, continuous leverage.
So they were using tomorrow's cash to build today's buildings.
Worse, they used the cash from pre-selling Building 3 to finish Building 1 while taking out a loan to buy the land for Building 5. It was a perpetual motion machine fueled by debt.
A Ponzi-like structure, essentially.
The turning point arrived in 2020. That's when China imposed the 3 red lines policy, which strictly constrained new borrowing for developers who crossed specific debt thresholds.
The regime changed overnight.
The moment that external financing regime shifted, the reality of Evergrande was exposed instantly. The operating model was actually just a refinancing model.
So without new debt, the whole thing just froze.
Without continuous access to new borrowing to fund new land acquisitions, the cash engine stalled, the construction stopped, the pre-sales evaporated.
What looked like aggressive growth capital expenditure was actually a dependency mechanism.
Precisely.
The business was structurally fragile, not structurally strong. They were not building an infrastructure moat. They were building a house of cards that required continuous capital injections just to prevent a collapse.
Okay, that's a chilling example of regime dependence. But what about companies that aren't reliant on massive debt?
Even without debt, we have to warn against the mirage of margins and false free cash flow. This is where investors get trapped by spreadsheets.
Trapped by spreadsheets, how so?
A company can appear to reach that free cash flow inflection point you described earlier with Amazon, not because the business is genuinely scaling, but through financial engineering.
So management is artificially inflating the cash flow numbers?
Management teams are highly incentivized to make free cash flow look healthy. They can stretch their payables, meaning they delay paying their suppliers for an extra 60 days.
Which artificially boosts cash on hand for the quarter.
Right. They can liquidate existing inventory without replenishing it. Or, most perniciously, they aggressively use stock-based compensation to fund operating expenses.
Stock-based compensation, so paying employees in equity instead of cash?
Exactly. They pay their software engineers in stock rather than cash. This makes the operating cash flow look fantastic, but it violently dilutes the actual owners of the business.
The cash isn't real. It's just being borrowed from the future equity value of the shareholders.
Exactly. And we can look at IBM as the classic caution against margin complacency. Investors often read stable operating margins as undeniable proof of business resilience.
Well, if a margin is stable, the business usually is too.
That's the trap. If a company maintains a 20% margin, the assumption is that the competitive position is secure. Around the late 2010s, IBM maintained superficially stable operating margins right around that 20% mark.
I remember that. They looked remarkably steady on paper.
The market looked at that and assumed the core business was intact, generating consistent, reliable returns. But beneath that 20% margin, the actual volume of the business was imploding.
How badly?
Overall revenue was declining roughly 30% over a multi-year stretch.
Wait, how do you maintain a stable 20% margin while losing nearly a third of your revenue?
Management was aggressively cutting costs, shedding operations, and optimizing the balance sheet to preserve the optics of margin stability.
So they were shrinking the company to save the percentages.
They were firing engineers, cutting research, and selling off less profitable divisions. Cost-cutting to preserve margin optics in a shrinking business is the corporate equivalent of losing weight by amputating limbs.
Oh, wow. Losing weight by amputating limbs. That is a brutally accurate way to phrase it.
It is what they were doing. The scale of the enterprise is vanishing. The actual footprint of the business in the global economy is shrinking rapidly, but the ratios look healthy on a spreadsheet.
You cannot cost-cut your way to compounding growth.
No, you cannot.
Okay, I'll concede the point on Evergrande. That proves definitively that leverage can masquerade as operational growth, and that a highly accommodating credit regime can make a fragile business look like a juggernaut.
Thank you.
And the IBM point is well taken too. But we are arriving at the absolute center of this analysis. The market universally believes that when a leading company commits to a massive, multi-year capital expenditure program, it is securing its future.
They view it as a guarantee.
Right. The consensus assumes that spending tens of billions of dollars proves a company is widening its moat, pulling away from competitors, and guaranteeing its dominance for the next decade. Investors see the announcement of a $20 billion factory, and they immediately price in future monopoly profits.
And that consensus assumption is exactly what we must shatter today.
Shatter it? How?
Diagnostic tool to evaluate a business is not the top-line growth rate, and it is certainly not the size of the capital expenditure budget. The true diagnostic tool is the freeze test.
The freeze test. Okay, walk me through that.
I want listeners to visualize this. If a company stopped all of its growth capital expenditure tomorrow morning, if they halted every new project, canceled every new factory, and paused every expansion, would the currently installed asset base still produce meaningful, durable cash flow?
Or would the business collapse on itself like the shale oil producers?
Exactly.
Let us look at the companies that pass the freeze test flawlessly. These are the asset-light masters of the modern economy. Apple provides the cleanest, most astonishing data point here.
Apple's numbers are almost hard to believe.
They really are. Apple lifted its free cash flow from roughly $10 billion in 2010 to $111 billion in 2023. They multiplied their cash generation 11 times over in just over a decade.
But the mechanism of how they achieve this is what matters.
Right. They achieved this staggering wealth creation while running at a capital expenditure to operating cash flow ratio of roughly 0.10.
Meaning?
That means for every $10 in cash the business generated from its operations, it only had to reinvest $1 single in physical capital expenditures.
It's an incredible ratio.
Apple outsourced the brutal, high-entropy physics of manufacturing to companies like Foxconn. Apple kept the low-entropy, high-margin design and software ecosystem for itself.
They offloaded the entropy.
Exactly. And Visa operates at an even more extreme level of capital efficiency. Visa runs near a 0.05 ratio.
They reinvest mere pennies for every dollar of cash they generate.
Visa functions quite literally like a digital toll road. The network infrastructure, the complex web of relationships between banks, merchants, and consumers is entirely built. It is an established ecosystem.
When a consumer swipes a Visa card to buy a coffee, that incremental transaction rides those existing digital rails at almost zero marginal cost to Visa.
The network is infinitely scalable without requiring concrete, steel, or heavy machinery. If Apple or Visa halted their capital expenditure tomorrow, their ecosystems would continue to throw off monumental cash.
The machine is built.
The ecosystem is locked in. New spending for them is purely offensive, not existential.
Now contrast those asset-light masters with the modern warning of what happens when a company tries to spend its way out of structural decay.
You're talking about Intel.
We must examine Intel's massive 2021 manufacturing comeback attempt. This is the ultimate stress test of the bold narrative.
They certainly threw everything they had at it.
Intel did exactly what conventional wisdom applauds. They announced heavy investments, aggressive reshoring of manufacturing back to the United States, and the building of strategic, cutting-edge foundry capacity.
The CEO laid out a bold vision to reclaim process leadership from overseas competitors like TSMC.
Right. Wall Street and political leaders lauded them for taking the necessary, expensive steps to rebuild an American technology moat. But look at the sheer scale of the capital furnace they ignited.
The numbers were historic.
Intel pushed its capital expenditure to operating cash flow ratio above 1.5. I want that number to sink in.
Above 1.5? So they were spending 50% more than they were actually generating.
They were spending 50% more on capital expenditures than the business was actually generating in operational cash. They were spending in excess of $25 billion per year on physical infrastructure.
Buying massive, complex lithography machines and pouring concrete for fabrication plants that take years to come online.
Yes. And what did all that spending achieve?
Well, the magnitude of that spending is staggering when you pair it with a subsequent outcome. Let us pause and look at what that $25 billion a year actually bought them.
It didn't buy them growth.
No. Despite operating this massive capital furnace, despite the political support and the aggressive strategic reinvestment, Intel's revenue fell from $79.0 billion in 2021 to $54.2 billion in 2023.
It's breathtaking destruction.
They spent an unprecedented fortune and their top line cratered.
It is a devastating sequence of numbers. You push your capital intensity to historical extremes, you commit tens of billions of dollars to physical infrastructure, and your top line simply collapses.
So what does that tell us structurally?
It tells us that Intel's spending was not widening a moat, it was a desperate, spectacularly expensive attempt to repair a moat that had already been breached.
The technology had already moved on.
Exactly. The technological leadership, the engineering talent, and the ecosystem trust had already migrated to TSMC in Taiwan. TSMC had the superior manufacturing process.
And clients like Apple and NVIDIA were not going to wait around for Intel to figure it out.
Intel proves that in a high-entropy, technologically ruthless sector, massive capital expenditure does not guarantee adaptation. It does not buy you a customer base if your underlying technology is lagging.
Sometimes, massive capital expenditure merely funds the most expensive possible way to lose market share.
Precisely.
Okay, I have to admit, the Intel numbers are staggering. When you spend $25 billion a year and watch your revenue compress by nearly $25 billion over that exact same 2-year period,
The thesis of self-funding growth is severely damaged.
It proves that aggressive spending is not an automatic cure for technological obsolescence.
It forces us to recognize that this dynamic, burning cash, in the pursuit of strategic dominance, is not entirely new. We have seen this exact destruction of capital in the pursuit of technological infrastructure before.
Are you thinking of the dot-com era?
I am. The parallel that immediately comes to mind is the global telecom and fiber optic boom of the late 1990s and early 2000s.
Oh, the fiber overbuild. That is a perfect parallel.
Companies were raising and spending billions of dollars to lay the physical infrastructure of the digital age. From a macro perspective, their overarching thesis was entirely correct.
They weren't wrong about the internet.
Not at all. The internet was absolutely going to change the world. Global data consumption was going to explode exponentially, and the world would genuinely need unprecedented bandwidth.
But the microeconomics were a disaster.
They were disastrously wrong about the microeconomics of their own industry. Companies like Global Crossing spend billions building vast subsea and terrestrial fiber optic networks.
They assumed that building the sheer capacity would give them unassailable pricing power.
They thought they were building a toll road. Instead, the entire industry massively overbuilt. Every competitor was laying fiber at the same time. Supply vastly outstripped demand in the near term.
And because fiber optic bandwidth is essentially a commodity,
The pricing collapsed to near zero. Global Crossing filed for bankruptcy in 2002. They were completely right about the future of the internet, but their crushing capital intensity destroyed them before they could live in it.
the infrastructure survived, but the equity owners were wiped out entirely.
Exactly. The world got the bandwidth, but the companies went bankrupt providing it.
That historical parallel provides the exact blueprint we need to evaluate today's market. You do not solve this problem by simply adopting a blanket, intellectually lazy rule to buy asset-light tech.
Right, because physical businesses can work too.
We know physical models can work spectacularly well if the mechanics are right. Look at Costco. Costco proves that heavy, physical retail models can compound massively over time if the unit economics are highly favorable and the business operates with negative working capital.
Negative working capital is such a brilliant mechanism.
It is. Structurally, it means Costco gets paid by the consumer for a massive jar of mayonnaise before Costco even has to pay the supplier for that mayonnaise.
They sell the inventory in 30 days, but they negotiate 60-day payment terms with the vendor.
Exactly. They are essentially using their own suppliers to finance their growth. Because their inventory velocity is so fast, their expansion actively lowers their marginal costs. Buying power and inventory velocity reinforce each other.
So what is the actual mathematical filter we should use?
Weight businesses where the ratio of capital expenditure to operating cash flow is below 0.50 and actively declining.
Showing that cash is scaling faster than the infrastructure needs.
Yes, you must aggressively underweight the capital furnaces. You must avoid the businesses where that ratio is above 1.0 and rising. We treat free cash flow as a confirmation signal, not necessarily the very first filter.
Right. We don't want to ignore the next Amazon just because it's in its gestation phase.
But we must demand post-investment proof. If a company is spending heavily, we must see rising incremental returns on invested capital. For every new dollar they put into the business, the profit generated by that specific dollar must increase.
We must see subsequent margin recovery.
If those metrics do not appear, you do not own a compounder. You own a narrative.
Well, we have arrived at a shared verdict here. The distinction between growth capital expenditure and maintenance capital expenditure is never perfectly clean on a corporate ledger.
Never. Management teams will always obscure the difference.
They will always paint their spending in the most strategic light possible. But understanding the true nature of a company's capital intensity is the only economic reality that ultimately matters to the long-term owner of the business.
It's the only thing that separates the survivors from the casualties.
A stock becomes a true compounder only when its maintenance burden continuously shrinks relative to the operating cash flow it generates. The business must be able to fund its own expansion organically, without diluting its owners with massive stock issuance or destroying its balance sheet with unmanageable debt.
The hallmark of a multi-decade compounder is not that it uses capital well, it is that it does not need much capital to stay great.
As we look at today's market darlings, the companies currently pouring hundreds of billions of dollars into artificial intelligence, data centers, advanced GPUs, and heavy tech infrastructure, we have to ask a very difficult question.
Are they Amazon, or are they Global Crossing?
Are we watching the long gestation of the next Amazon securing dominant, unassailable infrastructure moats for the next 2 decades? Or are we simply watching the fiber optic build-out of 2002 all over again, where the technology absolutely changes the world, but the companies building it drown in their own capital expenditures? This is the research desk officially signing off.